Hello and welcome to a special edition of the Download Podcast. I'm your host, Dave Richardson, and we are joined by Canada's hardest working economist, who's up from 25 hours a day to 30 hours a day lately. Eric, I can't believe between what both of us are up to right now that we were able to get you for 10 or 15 minutes, really just to what's happening with the tariffs has taken another turn, and we always like to catch up with you just on thoughts and for Canadian investors, just what they need to think about. How do we interpret this? What does this do to growth forecasts? What does it do to inflation, interest rates? And I won't take a whole lot of time because I know you've been pulling your thoughts together. You've probably already done a couple of presentations today to different groups. So I guess a bit of a surprise in some ways, because these are big numbers, some of these tariffs for some
hmm
countries, and maybe not so much Canada and Mexico. Uh, but at the same time, kind of, we were expecting something. Thought he'd probably come big early and hopefully pulls back later. But how do you pull all this together?
Yeah, I mean, gee, I think as a starting point, regardless of how hard you work as an economist these days, your forecasting record will not be great. I don't think too many people were quite predicting this. I was thinking yesterday before the announcement in the Rose Garden at 4 o'clock. What's the worst case scenario? Be 25% plus blanket tariff on Canada, Mexico. What's the best case scenario? Maybe a 10% tariff or something like that. Middle case, of course, somewhere between the two. And seemingly, Canada and Mexico are coming off, below better than the best case scenario, which of course wasn't on anyone's bingo card. It's almost hard to fathom how Canada and Mexico have gone from enemies number one and two to friends number one and two in the span of 24 hours. And so it's certainly some unexpected components of this are the main takeaway. As you say, Canada and Mexico seemingly getting off lighter. A lot of other countries, though, being hit maybe a bit harder than anticipated. In fact,
Yeah.
I would say if the focus is on the U.S., the cumulative U.S. economic impact is about what we expected in terms of the average effective tariff. It just seems to be, and I will say with an emphasis on a for the moment,
Yeah.
less on Canada and
Yeah.
Mexico and more on some other countries. And so, the EU is being hit at a 20% tariff, Japan at a pretty big 24%, China, I guess, is up to 54% if you include the 20 that was applied earlier to the 34. India is at 26. The list goes on, and there are quite a number of parties that are hit quite hard. Everyone has cracked the code for where these numbers came from, so it was not a sophisticated critique of value-added sales taxes or who has tariffs on the U.S. or anything like that. It was really right down to the who has a trade surplus, and your trade surplus with the U.S. divided by the total flow of trade into the U.S. from that country, and that's actually the number that reveals the tariff. And so I should say, I mean, to the extent that really the U.S. base objection is how come everyone gets to sell more to us than we sell to them, I can't say that's a completely inappropriate way of doing it, but it's certainly not the way that was advertised, I guess, going in. And so, significant damage to the U.S. for sure, just because, the average effective U.S. tariff rate is going up, and I'm seeing a big wide range of estimates, but I'm going to call it up to kind of a 15 or 20% kind of number, which is significant. And so the U.S. economy is likely in this scenario to grow on the order of a percentage point or a percentage point and a half less quickly over the next few years, which is a significant hit. And the price level is likely to be materially higher, percentage point or even up to 2 percentage points higher than it would have been. And so that's a significant hit as well for the US. We're left sort of, I should say, if we take at face value, what's emerged for Canada and Mexico, we're left saying, well, maybe Canada doesn't have to have a recession, which looked likely based on the expectation of significant tariffs. And conversely, of course, the outlook is a bit worse for everybody else. Though I would say I still stand by the general thought for almost everyone else, which is that most countries are not that exposed to U.S. trade, and so I wouldn't want to downplay the pain of a 24% tariff that, say, Japan will face and so on. But only 3% of what Japan makes is sold to the U.S., and so I wouldn't want to overstate that. I would say, and I'll let you get a word in edgewise here in a moment, Dave, but I would say to me the big question is that actually it as it pertains to the likes of Canada? And I have my doubts.
Yeah, and so is it the worst case scenario everywhere else? And as you say, around the best case scenario for Canada, but does that hold? And is this the worst of what we're going to hear everywhere else, and then it ratchets back? And
Yeah.
I'm actually just you probably can't tell from my background, but I'm at our office in London in the UK, and so I was just down on the trading floor talking to our bond traders and stock traders as the markets have been open for several hours here in Great Britain, and are just opening up as we're taping this now. But I was there with them at the open, and but one of the traders just saw me with my little Canadian flag pin that we're walking around with, and by the way, getting lots of love and affection as we sport our Canadian flags on our lapels as we're walking around a bunch of Canadians in London. And he's like, wow, what are you going to do with all the Americans who are going to be flooding over the border to buy their iPhones and Samsung Galaxies now? Because of the effective price of an iPhone in the U.S. is going to be what up 50 to I think they were trying to calculate somewhere between 50 and 80% off of this. So it's just you've got there's so many things going on, and as you say, and I think one of the advisors here said, there's a method to his madness and a madness to his method. And so you say, one of the kind of surprises was you could kind of do the calculation, work backwards with the math, and figure out how they came to these numbers, right? But we don't know if they're going to be the numbers longer term, and so there's
Mhm.
a whole madness in terms of we still really don't know how all of this plays out.
Yeah, that's exactly right. So I would say, and again, from a Canadian perspective, first of all, Canada is not completely off the hook here, and so let's recognize that for instance, anything not compliant under the USMCA is presently subjected to a 25% tariff. To everyone's shock, on March 6th, it was revealed that 60% of the trade between the two countries was not actually compliant with the USMCA. A lot of that was a function of paperwork, and so businesses have made those things compliant, and so I haven't heard too much screaming of actual flows that are encountering 25% tariffs, but there is a tariff on a subset of things from Canada, potentially 25%. The steel and aluminum tariffs are still fully on, and they affect Canada more than anyone else, and so that's a significant source of pain as well. The 25% auto tariff started, at least as we're recording this, started this morning at midnight. I guess midnight my time. I guess it was 6 a.m. Anyways, 5 a.m. your
Yeah,
time. This is
5 a.m.
getting
my time.
very confusing, but nevertheless, so those are on. And I mean, as much as like U.S. value added is excluded, any Canadian value added, which is, there's certainly some, you don't ship those parts and cars into Canada for no reason, that Canadian value added is subjected to a 25% tariff. So that's a big problem still for the auto sector. And it's been made quite clear that there are copper, forestry, pharmaceutical, et cetera, sector type tariffs coming. And a number of those, forestry obviously, but a number of those will be Canadian relevant too. So, Canada is being hit by some things. It was not a complete carve out. And then the big question is just, as you say, tariffs on today, off tomorrow, or vice versa. So what is the scope for deterioration here? And we honestly don't know. I mean, it's almost certain whatever I say is going to be wrong. That's certainly been the theme so far, and the
Wow.
experts
We're
have gotten this almost constantly wrong. Sorry, you interject, Dave,
Well, we're
and
we're
then
going
I'll
to come
come in.
back. I want to come back to that point in a second in terms of where we go from here.
Okay.
And I think I've got a more important way of framing that question. But I do want to go back. I mean, what we did talk about on our first tariff podcast, which I think was on January 30th or January 31st, was the idea that if you look at the sectors in Canada, you could get from all of the language where the focus was going to be. And now I'm hearing you again in terms of where we're not exempt, and it's autos, it's some of the agricultural side, it's lumber, steel, aluminum, right? This is where we kind of thought the focus would be, and that's where it ends up that it's been
Yep, good
to
point.
now.
Yep. I was saying this morning, yes, if I'd gone to bed on November 5th and just woken up today, I might have been about right in my predictions, but there have been some surprises along the way. And again, I will just say I don't think the surprises are fully done. And so one would just be surprises have been constant. Let's not
Uh,
grow complacent now. Again, hard to fathom. Canada, Mexico went from enemies number one and two to friends number one and two in 24 hours, and so I suspect there's just a different plan for them. We heard in the speech speech, in the White House speech that announced these reciprocal tariffs yesterday, we heard complaints about Canadian dairy. So it's certainly not likely that that was the end of the story on Canadian tariffs. And the way I've come to think about this is that there's certainly one very viable scenario is we know the USMCA trade deal is going to be renegotiated. Not quite clear when. It could be immediately, might be on schedule in 2026, but I would say sooner rather than later would be my guess. And so it probably makes sense to put those big tariffs, or at least to threaten the big tariffs against
On
Canada and
hold.
Mexico right before that, and that creates the leverage
Yeah.
for the U.S. to extract concessions. So I still think that that 25% tariff, which has been kind of delayed but not canceled quite, still needs to be heeded. And again, I guess as per that, the U.S. still is unhappy with border security in a North American context. It doesn't like the level of military spending that countries are engaging in, including Canada. Does not like at all Canada's digital services tax. Does not like value-added taxes in general. Doesn't just
Oh
apply to
yes.
Canada, but
Yeah.
doesn't like cheap currencies. Canadian dollar is pretty cheap. Doesn't like supply management. Of course, there is supply management. Has complained about some of the oligopolistic type service sectors, and so it's hard to fathom the net conclusion from all of that is and Canada gets no tariffs. And so I'm going to assume that there is still some pain to come, but I will still say that Canada is doing an awful lot better than we would have expected 24 hours ago. And so the odds of a recession have just gone down. I'm not sure they've vanished altogether, but they've gone down. And of course, that's a welcome thing. To some extent, it's been the opposite trend in the rest of the world. But again, I think they're sufficiently limited in their exposure that they will be okay, as much as no one celebrates big tariffs. And the U.S. is potentially in for a significant hit itself. And I don't think it's a full recession-sized hit, but tongues are wagging to that effect, and that's not a bad conversation to have as well.
Yeah, and just so you know, this is a very Canadian dairy-friendly podcast. The one thing as I travel around the world, the thing I miss more than anything else when I'm on the road, when I have my milk and cookie at night, is I'm not drinking my Canadian milk. There's no better milk in the world. Anyways, that's an aside. But the growth thing, we talked a lot about this. We were talking to some of the economists and lead investment managers over here in the office in the UK this morning, and the focus was that U.S. growth. So we had Goldman Sachs come out. They had bumped their recession risk from 25 to 35. I think
Mm-hmm.
we had a couple of forecasters here in the UK who bumped it from 5 to 25, and
Mm-hmm.
so I know you've been at the lower end, but you were starting to get more concerned the last time we spoke. Anything you see here that dramatically shifts your view on U.S. growth for the remainder of the year?
Yes, I mean, the risk has gone up, undeniable. I mean, anytime you downgrade a country's growth forecast, just given kind of the error bars on either side, a bigger part of that error bar is now negative. And so
Yeah.
certainly the risk has gone up. The number we've officially given was we had thought the risk was about a 10% chance for the U.S. over the next year of recession. We put it up to a 25% plus. I think the plus is doing a lot of the work there right now, and so it probably is maybe a little higher than 25%. I would still really struggle to think it's 50% or higher. I certainly appreciate that tariffs do a number on growth, and there is the risk that households and businesses really just screech to a halt, and you can construct a narrative. But equally, all the modeling that we do would really struggle to say that even a 15 or 20% average tariff rate in the U.S., which I think is loosely where we've ended up, would be full on recessionary. 85% plus of the U.S. economy is domestically oriented. It's a fairly small share
Yeah.
that is imported, and so the outlook is down, and we're budgeting now for sub 2% GDP growth this year and next, and it could even be shy of that. But I would struggle quite to get all the way to a recession. I will say we've been tracking, dusting off some pandemic era type indicators and
Uh,
looking for real time metrics of is there a collapse happening right now, and not seeing it in the U.S. right now.
yeah.
Jobless claims are still quite low. Some of the weekly economic activity indices seemingly still trending a little higher. We've heard some airlines complain, and I think probably the tourism and boycotting and
Sure.
so on is
Yeah.
perhaps
Yeah.
weighing there to some extent. And maybe I'm underestimating the extent to which Americans are tightening their belts a bit as well, and doing less leisure travel. But in general, I would say less growth absolutely, and potentially, particularly with high uncertainty recently, notably less economic growth. I'm a bit of a skeptic when it comes to a full recession. I think we'd need to see a bigger hit than that.
Yeah, like we were talking about here, the consumer's still in pretty good shape. What we'll talk about when we do our Friday jobs report podcast the next time, and that's got to be oh, Actually,
I, th-
it'll be next
we
week.
stole it forward. So I'll just
I think
say
we
the
stole it
numbers are
forward. Well,
looking
the next
okay.
time we're talking about the labor market, we'll say that the labor market, because of changing immigration policy, is likely tightening. So you get some upward pressure on wage growth. So you probably run a little bit higher inflation, but people have money in their
Hmm.
pockets, so the consumer's still strong. So you add it all together, like you say, it's kind of hard to get to a recession. Obviously, not impossible, and this is
Yeah.
not. This is going to hurt, but it's hard to get there from here.
That's the current thinking, and so we'll see how things play out, obviously. And we've had so many twists and turns. This might not be the last. Almost certainly isn't the last. But as it stands now, that's our best guess.
And so Eric, I think as we've said, the forecasting is virtually impossible, and it seems like that's almost by design. Let's keep everyone on edge. Let's keep everyone guessing on as to what's going to happen, which again seems like madness. But is it there's there a method to the madness? But if I'm an investor sitting in Canada, right, and I'm looking at my portfolio of bonds and stocks, regardless of how things play out, what do I think about this today as I wake up and I see these tariffs and I see the way markets are acting? What do you think I should be thinking about as an investor?
Yeah, well, gosh, I mean, I have to say, just from a regional standpoint, obviously Canada suddenly looks a little bit more attractive than it did
Yep.
before. That's maybe the big
Yep.
obvious conclusion, though with that caveat that's probably not quite the final word on the subject. But nevertheless, I think it says something that Canada didn't come in for the big giant blow today, so that's promising. I would say in general that it is worth if one is bold or willing to tolerate a bit of uncertainty. There are opportunities that come along when markets decline, and so that's not me saying necessarily that the U.S. market or international markets or the Canadian market necessarily is done its decline, but nevertheless, it is on sale relative to where it was a couple of weeks ago, and dollar cost averaging and such is not a
Yeah.
bad idea, even if there could be a further decline, and so that's certainly very central as well. I do think that to the extent we're seeing significant moves in international markets, I do wonder whether those are overreactions personally, just to the extent, again, that thesis that the tariff damage may not be that great for some of these countries. And it depends on the European auto
Sure.
sector is, of course, significantly
Yes. Yep.
exposed and so on. But in general, I think a lot of sectors are going to do just fine internationally on this basis. And of course, they're so much cheaper than some of the other markets. So I guess that's just me saying on a number of fronts that I would still be intrigued by and perhaps attracted to some of these international equity markets in particular. And then, of course, it's always just worth remembering the whole reason we have bonds in our portfolio and cash in our portfolio alongside those equities that often are the strongest performer is to provide ballast. And so as the stock market
Yep.
declines, your bond portfolio is likely holding together pretty well. To the extent that glaring obvious opportunities come along, it's nice to have a little cash along for the ride in terms of the ability to deploy it as well. And so this is a time to have a portfolio that's not too wildly different from balance, so that you can actually take advantage of opportunities as they come along. And of course, we're active investors, and so I don't think I would say we celebrate or entertain volatility, but nevertheless, there are opportunities that arise at times like this to take advantage of movements, and so we're trying our hardest, of course, to do that as well.
Well, we had Sarah Riepel on a couple of weeks ago who had added to the equity position in her portfolio a
Mm,
little nibble, 1% add.
yeah.
And we talked to her about, well, why are you adding now? And she said, well, we were off 10%. We think there's an opportunity to deploy a little bit. And
Hmm.
then she was up 5%. I saw her a couple of days later and start to celebrate. She goes, don't celebrate yet. Don't celebrate yet because we with a lot of things are happening, we could fall back down. So now we come back down and maybe nibble a little bit again. And then you look at the bond side, and she had added a little bonds a couple of months ago with the U.S. 10-year Treasury up around 4.75 for I think 4.80. And you're banging on the door to go below 4. So that bond portfolio has provided that insurance as you look for where you want to really weighed in on the equity side, and the dollar cost averaging approach we've been talking about for a while now is seems to have been a fantastic approach, and this is exactly why that approach can work.
Absolutely. And I won't prejudge, but we're literally in 16 minutes. I'm going into the next such tactical asset allocation meeting, and we'll see what we decide. But nevertheless, there are opportunities when markets move.
Well, that is my signal to let Canada's hardest working and busiest economists go. So, Eric, thanks as always for taking the time. Great update. I know you've helped investors across Canada, Thank you, and enjoy your meeting.
Thanks so much. Bye, everybody.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.